Well, let's get some market perspective then. Rashesh Shah joins in, Chairman and CEO of Edelweiss Financial Services. Rashesh, hi, good morning. Before we talk about the overall market, a word on HCL Tech and the overall IT pack. Now that we have seen 2 out of 5 big earnings, and of course we'll have TCS also later.
True, I think as we have seen, the IT story continues to get stronger and stronger. And even from a valuation perspective, if you see, most of the companies are not very expensive yet. And I think if you saw a couple of years ago where there was a switch away from IT into banking, and if you saw most of the funds, FIIs, had over allocated to banking and were under invested in IT, which I think started reversing about a year ago. So I think this the IT underweight story in banking overweight, which was there earlier, has got reversed in the last year, and I think that continues. And my feeling is at least for another year and a half, the story continues to look good. Stocks are not overvalued. They are clipping along at good ROEs, good growth, and with the rupee weakening and remaining in this range, it's always going to be a huge benefit, along with the recovery in the US economy. So I think all this put together, it's a great story, continues at a reasonable price.
Okay. Rashesh, hi, good morning, and thanks for joining in. Well, the sector that's really getting hit hard today is telecom. All your telecom names, Bharti, Idea, Relcom are all lower. There is, of course, the fear of the participation of Rel Jio in the upcoming spectrum auction, which may perhaps hit the profitability of these companies and increase competition. But how do you approach this entire sector?
I think exactly as you said, I think this sector has consolidated, but I think the large new entrant is going to again create some amount of upheaval. And along with that, there is still a lot more government involvement in framing the rules from a regulatory point of view and all of that. And it's a theme that we will see at least for the next until the elections, that people will still try and stay away from sectors which can be strongly influenced by government policy and government actions, and especially where there is still some amount of over competition. I think people will find solace in sectors which are slightly away from the government influence so much, which is mainly, as we spoke earlier, IT and pharmaceuticals. And earlier FMCG was also there, but I think unlike IT and pharma, FMCG valuations went up. So when we talk to large institutional investors, they still find a lot of solace in IT and pharma and away from all the other infrastructure-oriented companies.
Rashesh, what's your overall call for the market for this year? Do you think, last year was really essentially stock-specific. The market overall was quite flat, but within that, you had a lot of stocks going up or down 60%. Do you think we'll have something similar this year, or this year could be a bit of top-down for the market?
I think in the last year, markets were very volatile all through the year. Here, I think there will be equal amount of volatility, but it will be fairly, in a couple of months. Like as all of us know, around the election time, we should see quite a bit of market volatility around April, May, June in those 3-month period. But I think outside of that, I would see the market to remain strong for various reasons. I do think Indian equities is under-owned by most of the Indian investors, and for the last few years we have seen outflows from insurance companies, from equity, from the mutual funds, equity mutual funds, all of that, which has at least started stabilizing. And along with the markets being almost at a new high, and hopefully, with the rupee being stable, with inflation coming down, so a lot of the macroeconomic parameters which really crippled India for the last couple of years, not all of them have got solved. I think the fiscal deficit and overall inflation is still a problem, but the trend in inflation, the rupee stability, the current account gap coming down, even the corporate earnings is fairly good, the global economy getting revived with the US markets coming back, all of those are good news overall for the market. And also there is an asset class allocation. We're seeing more and more investors switching out of commodities and real estate into equities now. So I think equities, and I would say fixed income, because current rates are still high and everybody expects inflation to come down, are the two sectors, are the two instruments very strongly favored by investors. And I think the bonds will stay in favor until interest rates start coming down, which will be maybe over the next 3, 4, 5 months. And equities should stay in favor for the whole year. So I think it should be a good year for equities.
Okay, since you are talking about what investors should do, let's talk about the NCDs that Edelweiss has issued. I understand that the issue is open from 16th to 27th of January. What kind of returns would this NCD offer?
As you know, the issue, as you said, has opened today. It's a 250 crore issue with a greenshoe of another 250. So about 500 crores altogether for the issue. And we are offering returns from 11.6 to 11.85% per annum on a monthly basis. So actually the annualized yield is much higher, and the annualized yield can be as high as 12.5 onwards for investors. So it's a good coupon. It's the issue is rated AA by CARE, and as I said, a lot of investors are looking at good returns from bonds and fixed income instruments. Especially they are increasingly switching out of bank deposits, because the bank deposit rates have not gone up in the last 5-6 months, while interest rates have gone up a little bit. So on that count, we are seeing a lot of retail investment. For us in Edelweiss, this is our first NCD issue in the retail space, and up till now we've been growing by borrowing from the mutual funds and the banks, and we are now expanding the third source of funding for our credit book, which is through the retail bond issue.
So Rashesh, just a follow-up question then. Do you expect the interest to be high in some of these NCDs as we move forward from the retail and not as much as equities? Because retail has been completely absent from equities because fixed income for them has made more money over the last 4 or 5 years. Do you think that trend will continue this year as well?
Yeah, as I said, I think at least for the first 3-4 months I would expect it to continue until interest rates start coming down, because currently the hypothesis is that interest rates are still fairly high, but hopefully inflation is coming under control. So at some point of time, maybe in the second half of the year, interest rates have to start falling. So until then, I think a lot of investors want to get, if you're getting after on a pre-tax basis between 12 to 13% return, it's not bad, because current expectation of equity market returns are about 14 to 15%. So there is not a large equity premium in the eyes of the investor when I'm getting say 12 to 13 on bonds and I'm getting say 14, 15 in equities. What I expect will happen over the year, maybe in the second half of the year as the interest rates come down, is that the bond yields will fall to maybe 10 to 11% if there is a RBI cuts rates and all that. And if there is an corporate earnings growth rate, expectation from equity returns will go to say 16-17%, and it is at that point of time that the gap between expected equity returns and the expected bond returns will widen, because currently the gap is very small. It's only 150 basis points or so, which is not good enough, because in the past we have seen that the gap has to be at least 300-400 basis points for equities to start also looking attractive as compared to bonds. So I would expect that should happen after the elections, hopefully.
Okay, Rashesh, thank you for stopping by and giving us a view on both the markets as well as what investors or retail investors should be doing at this point in time in the markets.